So how it works, as I said, we are applying the elimination framework first. So we are covering around 620 companies internally, and there are five factors which we use to first eliminate. So the first factor which we are using is low wall. So again, here the the purpose of using low wall is not to identify companies where the volatility is low, but we are using low wall factor to eliminate high wall names, right? So out of 600 companies which we are covering, we are trying to remove first high wall names out of the universe. That works very well because in a way, a lot of companies where the perception of corporate governance standard is poor, a lot of time you would have observed that those companies have a higher stock price volatility. So in a way, eliminate companies where the volatility is very high. The second parameter which we are using is valuation, and again valuation is very important. We are not trying to find the cheapest values which are available in the universe, but we are trying to eliminate the expensive one. So again, the approach is not to buy cheap value companies, but avoid the companies where the valuations are very expensive. The third factor is quality. Again, here we are trying to identify companies where the quality is deteriorating. So again, eliminating the companies where ROE, ROA, ROIC, those factors which are in a way framework to identify quality companies, if they are deteriorating, we are trying to avoid those companies. The fourth factor is earning growth. Again, we are trying to see where the earning growth is in a way lower compared to the universe which is left. So eliminating the companies where the earning growth is not very strong. And the last factor is price momentum. After the four factor which are more fundamental driven, we are trying to use price momentum to identify companies which have a positive price momentum that way. So that way, these are the five factors which we are trying to use on this 620 companies which is under coverage. And after elimination, we are left with around 180 to 200 companies. And the fundamental approach of business management and valuation is then applied to this 180 to 200 companies, and the portfolio is created out of it. Now we have done back testing, and it has actually done the outcome of that back testing was very strong. Even the equal weight portfolio of top 100 companies or even top 250 companies would have generated sizable alpha compared to the compared to the benchmark. So that way, we believe that this combination of fundamental plus quant investing or using data in an efficient way will help us to do well over a longer period of time.